Hey everyone, and welcome to episode 1.2 in the Investing for Beginners course. Today, as you probably inferred from the title, is all about the mechanics and economic theory that makes stock prices move each day. If you take a look at CNBC during the trading day, which by the way is 9:30 to 4 p.m. Eastern Time on Mondays through Fridays, you'll hear the reporters talk about various stocks, the news associated with them, and the resulting prices. Every public company offers investors with a chance to buy their shares, or a piece of equity in the company, causing ownership for the investor. Each company offers millions, sometimes billions of shares to the public. The price that you hear those CNBC reporters yelling, and the prices that show up on your stocks app, are simply the current amount of money that an investor would need to pay to own one share of the company. When a company has its IPO, the initial public offering, the biggest problem is deciding on a price that is not too high or too low. The reason for this, and the reason for prices moving each day, is valuation. On Shark Tank, everyone's favorite show, small business owners try to convince investors to provide capital to grow. Often, the biggest issue with those small businesses is that their valuation is incorrect, and that shows the investors that the owners aren't very confident or not business savvy. The same type of judgment applies to larger, public companies. The IPO should value the company at the correct amount of money. Anything else, and the stock's price will go haywire. Apart from the IPO, each day provides another opportunity for investors to value a company. Investing, by conceptual definition, is providing money now in the hope that the value will increase tomorrow. Each day, there'll be some news about the company. Maybe they released a new product. Maybe they hired a new executive or announced a stock buyback. Any type of news can dramatically impact a stock's price. It all depends on whether investors think the news will help or hinder the company in its future. If it'll help, then investors will likely buy the stock now, since the news will help in the future. If the news will hurt the company in the future, then investors will either stay away from the stock or sell their shares. This might sound complicated, but I'm sure any confusion will go away once I give you a real-life example. Sticking with our example company from the previous videos, consider Apple. Say its stock price trades at $120 a share. One day, there is some news that Apple might be releasing a car in the future. Investors will be excited about the news, since Apple is making something new, so they will buy the shares now with the hope that the price, which is currently $120, will rise. True enough, Apple releases a car 2 years later, when the price is at $157. However, Apple reports earnings a few months later, and the car didn't sell too well. Investors, sensing that the car will not help Apple grow in the future, might sell their shares. A few months later, Apple's stock price went down to $140. When there is a transaction of buying and selling shares, that affects the trading price. If I buy one share, then the stock price will rise. However, in real life, one person buying one share will not really change the price. Each day there are millions of people trading billions of shares of every company in the market. Each transaction will affect the price, until the trading day ends. If a stock is down on the day, that means more people sold shares than bought. If the stock grew, then more people bought the share than sold. In terms of economic theory, stock prices move based on supply and demand. If a company's products or services have high demand for their supply, then stock prices will likely rise. If a company's supply of its products or services is more than the demand, then the stock price is likely to go down. The supply and demand model is a very simplified example of how investors seek to revalue a company whenever any news comes out. In the end, the goal of investing is to gauge any news about the company to see how large the impact will be, and then make a transaction based on their findings. It's all about revaluing the shares at the price the company deserves. That's why you hear the words overvalued and undervalued so much in markets. This whole idea can seem daunting, but the underlying concepts are not difficult to understand. Investors revalue the shares of a company by buying and selling stock in the hope that others will as well, and correctly put the company at the valuation it deserves. That's really all there is to stock prices. Pretty simple, right? I hope this video was helpful, and that you now understand why prices move on the stock market. Please like and subscribe to this channel, and be sure to stay tuned for the next videos. Next time, we'll understand what exactly the New York Stock Exchange is, and how it differs from the Dow Jones Industrial Average or the S&P 500, as well as how the market actually works. Thanks for watching, and keep making money.